Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Mark Hutchinson. Mark has 40 plus years in the steel industry, which forged him into a seasoned investor and entrepreneur. He is a business executive and a respected insurance professional. He's not only a passive investor in many asset classes, but also a master of passive wealth creation, incorporating infinite banking concept to amplify his returns. After 2008 financial crisis, Mark discovered infinite banking concept, transformed his approach to wealth and finance. Now he passionately empowers clients to reshape their financial perspectives and uncover hidden truths. As an authorized IBC practitioner, Mark is committed to simplifying the concept for others. Through his guidance, he demonstrates how strategically incorporating dividend-paying, participating whole life insurance can accelerate long-term wealth creation, even within a diverse, active, or passive investment portfolio. So, Mark, welcome to The Wealth Flow.
Thank you. Great to be here, Keith.
Great. And Mark, I usually will like to start with, just kind of where you grew up and, what led you eventually to not only the steel industry, but also infinite banking and being an investor.
Fantastic. So I have an interesting background. I grew up in Africa. I am a U.S. citizen. I was born in the United States, but went over at a very young age. Grew up in Africa, was educated there. And we were a farming family. So used to hard work, a lot of things going on all the time. So I guess from a very early age, I was very interested in business, seeing business all around me. So at the age of 18, I decided that I would like to come to the U.S. and continue my education. So I came over here alone. And by age 22, I had started a business, a steel business. And I think I did that primarily because I had had a number of small jobs, different things, kind of weird things as you do when you're young. And then I came across someone who said, hey, we have a welding position open. So I was like, okay, well, I can do that. So jumped into that welding position. One thing led to another, and I just decided I can do this on my own. So I built a large company in California. It was actually located in California. And it was there during that time where I sort of had my first introduction into real estate. So it was commercial real estate because the property that I had my shop on, I was leasing and it came up for sale. So I got together with some other investors and we bought the property and the property next door, and we developed with me as the anchor tenant. We put up a concrete tilt-up building and then leased that out and then put up a pre-engineered building. So that was kind of Yeah, it was neat to get that early introduction into commercial real estate. And then from there, it sort of led to some international real estate, which I still hold today. And now I invest as a passive investor in commercial real estate deals of all asset classes. But prior to sort of 2008, I was an equities guy. I've always been an
Okay.
equity guy. Love being in the markets, and did a lot of investing back at that time in my own company. You could actually invest the profit sharing assets for your employees, which
Hmm.
no one will touch today, right?
Right, right.
Maybe I was just too naive, but I had a lot of success doing that. And that sort of led me on this journey of equities. And then in '08, when we had the market meltdown, I lost a lot of money. And, I know I'm not
Right.
alone there. And it just was a seminal moment for me. I just had enough at that point and decided that I needed to look in a different direction, try to figure out something else. So that kind of led me down this path of looking for alternative investments. And it was at that time that I stumbled into the infinite banking
Hmm.
concept, which frankly changed my life at that
Wow.
point.
Okay. Well, there's a lot there, Mark. Maybe if we can go back to, so tell me a little bit more maybe about the steel industry and like what were you doing? You mentioned welding, but that led you to the steel industry. But what was your company's primary purpose? I mean, were you casting steel or creating it, or was it more of supplying different builders, developers with their steel? What aspect of that job did you?
Yeah, no, great question. So I was a steel fabricator and
Okay.
erector. So we would build buildings for
Wow.
people,
Okay.
Um, yeah, when you drive down the road and you see a steel skeletal frame going up, that's what we did. So that's the business that I've been in for my entire career, is structural steel and steel erection.
Hmm. Okay. And then you ended up purchasing the land along with some investors that you were leasing at one time. When you put up those, I forget how you referred to it, but I know exactly what you're talking about. It's like the concrete walls that you put up into position, and that you see strip centers and different things a lot of times built out of. But what was that, a storefront? Was that a strip center, or was that like an industrial park, or what type of tenants were you putting in those in that development?
Yeah, it's interesting because back then, I know what they would call it today. So today, the term would be a contractor's garage.
There you go.
So
Okay.
it had a little bit of storefront on the front. It had storage in the room, behind where they could park vehicles. And so they were primarily small commercial tenants that went into those buildings.
Okay. That's great. That's really neat. That's some good exposure for sure. You've seen a little bit of everything. Maybe let's go back even a little bit further to, where in Africa did you grow up? And, maybe tell us just a little bit more about that experience of growing up in Africa. That's obviously is kind of a unique deal.
Sure. So grew up in Lusaka, Zambia, and
Okay.
we had multiple farms around the area. And I was educated in Zimbabwe,
Okay.
600 miles from home. So it was a boys' boarding school,
Huh.
which is
Wow.
a little different than, the education system here. It was year-round school. But during all the breaks, of course, going back to the farm, I always was engaged in whatever was going on the farm at that time. So used to doing all of those things on the farm wherever I could help out.
Yeah. Yeah. That's neat. That's neat. Okay, well, cool. Well, tell us maybe a little bit about what were you in? You said were investing in equities. What else were you investing in up to 2008, and then maybe how did going through that? You mentioned losing quite a bit of money, and you're right, you're not the only one. But it's never, that's not one of those groups you want to be in regardless, right? It's never fun, even if you're not the only one losing it. But maybe tell us a little bit about what that experience led you to from there.
Sure. So, I had primarily been an individual stock investor. So, rather than, well, I guess in the earlier days, ETFs weren't really a thing. So it was
Right.
individual stocks. And I had taken a pretty good beating during the dot-com bust. So remember there, I mean, all you had to do to essentially make a lot of money as a company is just put .com at the end of the name of your business. And basically you were then a .com darling, and your stock would, run up 10,000 times. So during that, I obviously made a lot of money, as did many, many people. But then when the day of reckoning came, I got shellacked, as they say. So I continued to sort of go down the road of the individual stocks. I still had that interest there. And even in 2008, I hadn't really transitioned into more of an ETF blended approach. So, it was always individual stocks. Had a lot of luck, and I had obviously some things that didn't work out so well. And then
Right.
it was the '08, because remember, you had the .com, you had the European currency crisis, and then you had the Asian currency crisis, and then we had Black Monday, and then we could just count them on 10 fingers, right?
Yeah.
Of all of these events that had occurred to the markets. And so it was that point where I was looking for something else. And I was actually subscribed to a letter called the Palm Beach Letter, which was a stock picking letter. And
Mm-hmm.
and they teased up this thing called income for life. Like, what is income for life? It sounds interesting. So I read the letter, and it was basically the infinite banking concept, but they called it income for life. They had released it in a series of letters. So they would give you a little bit, just enough to keep you going, oh, wow, what's that? And then you had to wait until the next letter.
Yeah.
And so they teased this thing along for quite a while. Around about the, I don't know, fourth or fifth letter, I started to figure out that I could probably find out what this was. And so I started researching, and I said, wait a minute, this is infinite banking. So at that point, I really dove into it sort of headlong, and realized that could make a dramatic change in my financial position. And in fact, it has. So I've deployed that strategy across my entire personal life, investing life. That's kind of where I live now, is the IBC.
Yeah. Well, can you maybe explain, for the audience, maybe folks that have not heard about infinite banking, what it is, just kind of we talked a little before the show, but just really simplify it for everybody. What is it exactly?
Yeah, great question. Um, it's basically taking specially designed dividend paying whole life insurance as a product, because you have to have a vehicle or a chassis, and flowing capital into that insurance product and overfunding it so that you create a pool of capital that can then be accessed by you at any time, and then use that capital to improve your financial position. So normally when you say life insurance or whole life insurance, you lose like half the audience immediately, right? It's one
Right.
of those, it's the moment where all they hear is Dave Ramsey and Susie Orman, and, God bless them. They've helped a lot of people get out of debt, but they kind of have this, they're a hammer and everything's a nail. And it's great to get out of debt, but when you get out of debt, your strategy needs to change. It's a different strategy when you're buried in debt than when you're not. So,
For sure.
yeah, so it's one of those things where so many people are turned off by life insurance, but it comes from a point of not understanding how the products are used, how they can be leveraged, how they can be constructed, And so once you, kind of go into that world, start looking at how that happens, you realize very quickly that there are some tremendous advantages to utilizing that product in your life. My goal is to move capital into my policy. And when I move capital in there, it now starts it in motion. So I like to say we need to add velocity. So once we start to add velocity to our money, we can do it in a manner using whole life insurance to put it in that motion forever. So not just for a year or 2 or 5 or 10, it's forever. And if I can have, my capital earning a rate of return compounded forever, then I'm very interested in that, because I can't do that in a bank, right? Think about a real estate investor. A real estate investor is going to come in and they're storing capital. They build up capital and then they have a deal. And what do? They go take out the capital from the bank and they invest in the deal. And there's nothing wrong with that, except that when you really look at what's happening there, Keith, the minute you take your money out of the bank, you are giving up the right to earn a rate of return on your capital. Right? You forfeited that. So now that capital is no longer doing anything for you. But if I took that same capital and I put it into my life insurance policy and gave it velocity to where it can now earn a rate of return going forward for the rest of my life, and then I took a loan and I go and I purchase that real estate, now we're talking about a completely different animal here. So that's kind of the simplistic way of explaining IBC, is just to fund a policy, create a pool of capital, utilize that pool of capital to go do other things and stop transferring wealth to other parties, like financing institutions.
Makes sense. What, let's maybe talk a little bit. And I'm going to ask you about, some of the different types of investments that you can make and utilize this, once you've funded a policy. But before we get there, maybe we should start with, how one funds one of the policies. So, if I sell a property, if I do this or I do that, and I've got a chunk of money to be able to put into this and fund it initially. Tell us a little bit about, how that's structured and, how much of that you're able to pull back out to be able to use for one of these investments. And there may be some variations depending on which product you choose. But if you don't mind exploring that a little bit for us, that'd be great.
Absolutely. So the beauty of the IBC concept to me lies in its scalability, right? Because we're all at a different point in our financial journey. So for the small investor who maybe doesn't have a lot yet, the IBC concept allows you to fund a policy in a small way. And when I say small, I would say, sort of in the 5,000 a year type of range. It really doesn't pay to do it less than that. And at the end of the day, you're not really moving the needle, right? If you're, with very, very small amounts of capital. So, and then you can start to build this capital base over time. And maybe you do that for a number of years. Maybe it's 5 years, maybe it's 10 years if you have a small amount of capital. The thing is, though, you're building capital. For someone with more financial means, there are a number of things we can do. So in the example that you just gave, where you sell a piece of property, you have a chunk of cash, and you want to put it into a policy, you don't have anything started yet, we can absolutely fund large chunks up front. So if you had 300,000 coming out of a property, you want to get it started, you want to start that velocity of capital. You could put a policy in effect. You're probably going to see somewhere around 250 of that available in the first year. You might be able to get more depending on the product. So it just depends. I would say kind of the on the large side, the most you could do is somewhere close to $1 million for first year premium. Those are for
Okay.
larger clients, but there's lots of strategies wrapped around that. For the average person, what I see kind of as an average is a lot of people in sort of the 10 to 25,000. Somewhere in the 10 to 25,000 is a very common person who will fund a policy. And I think that what's important to understand here is there's a cost of life insurance. I mean, it's the vehicle that we're using. So what we want to do is have a product that allows chunks of capital to come in to our policies. What I see a lot is companies that don't allow that. They'll allow a range of capital that can move in. So let's just say that you have a policy where 1/3 of it is your base premium, and that's required to keep the policy in effect. And 2/3 of it is is funded by what we call a paid up additions rider. The paid up additions rider is a way to move capital into your policy the most efficient way possible. And so,
Okay.
a lot of companies will then put a very restrictive band on that to where you can skip 1 year, you can make up 2 years, you can do this, you can do that, and maybe you can go an extra 30%. But let's say that funding is set up as $20,000 a year that you're putting into that paid up addition rider. What do you do if you have 150,000? Well, now what? You can't get it into your policy, right? So we want to make sure that we're dealing with companies that can provide the flexibility that allow us to put chunky income into our policies. And that's been something that I've always been focused on. For the people that work with me, we're dealing with chunky income. So we want to be able to get that in there.
Yeah. Yeah. Okay. That makes sense. And so, kind of as you're describing this, I'm listening and I'm thinking there's a couple ways that people could do something maybe similar, although there's differences. And so one, I'm thinking of kind of the parallels of a self-directed IRA. And maybe for the audience, if they're kind of thinking along those lines as well, what are some of the distinctions? What separates the infinite banking concept with just like a self-directed IRA, for instance?
Mm-hmm. So I do both. I invest
Okay.
in syndications with my self-directed IRA, and I have my infinite banking. So I'm on both sides of that.
Okay, perfect.
Yeah. So in my self-directed IRA, obviously, I don't have to deal with taxes today. Right?
Mm-hmm.
But what I give up in that, Keith, is I give up all the tax benefits. So when I'm investing using my self-directed IRA, I don't have any benefits. And so I'm not getting any depreciation. I'm not getting any of that flow through to me personally as an investor. When I use my IBC policies and I invest through that vehicle, now I get all of that tax advantage coming to me as the investor. So that's a large, I would say, a very large distinction between the two right off the bat.
For sure. Yeah.
Yeah. Second thing is the taxes down the road. So, as you know, that self-directed IRA, ultimately you're going to be paying the taxes on that. So in the world that I'm in, what I want to do is use after-tax dollars to fund my policy and then move myself into a tax-free environment for the rest of my life. So
Yeah.
the growth within my policy is tax deferred, but we can take the capital out of it in a tax-free manner, doing it the right way. So that just comes down to understanding how to move the capital out of the policy when it comes time to, let's say, use it for retirement.
Mm-hmm.
So those are the big distinctions between the two. And I realize people can also use Roth money and things like that. But I really like using the IBC method for my syndication investments. because again, I sort of have money working in two places simultaneously. And I don't get that in my self-directed IRA. The capital
Yeah.
is the capital, right? It just is there, and it's got to grow by the return that we receive on the investment that we're making.
Okay. And then what about if you use the money within the IBC and to invest in, say, a syndication like the example you gave, are you susceptible to UBIT like you would be for, say, a self-directed IRA?
No, I do not believe that you have that issue. It
Okay.
primarily is going to show up in that self-directed IRA. And I have an investment right now that is subject to that.
Okay.
Anytime you have lending on that, right,
Right.
in that deal, we get into trouble with that. But I don't have that issue on the other side.
No, that's great. And when we talk about dividend paying, participating whole life insurance, can you maybe explain that? Is there a difference, or are most of the infinite banking concept providers, do most of them use a dividend paying whole life insurance?
Yeah, I think that the most of the people who are using the IBC concept are
Mhm.
really students of the Nelson Nash Institute. And,
Right.
and people coming out of that. I'm an authorized practitioner with the Institute. And, Nelson was a big proponent of dividend paying whole life insurance as as the product that should be used. It's the only thing that I would use with my own capital. So it's the only thing I use with my clients. I
Yeah.
don't want to get into any exotic products. I don't want instability later on in life when my insurance costs go up inside of my product. I just don't want to be in that world. And I don't want to put my safe capital up against market risk. So
Yeah.
yeah, if I want market risk, here's what I'll do, Keith. I'll take $100,000 I'll take a loan against my cash value and I'll go put 100,000 in the market. That's how I get market exposure.
Yeah.
So yeah, I don't need it in my underlying product that I'm trying to build long-term wealth over, because I really use the IBC concept and the dividend paying whole life insurance as the foundational element of my wealth pyramid. And I stack everything else on top of it. And at the very top of that pyramid is my speculative money. So it's just the
Right.
small amount. And that's where I go and I take the flyers on this and that and the other thing. So, but
Yeah.
I'll through a policy loan.
Okay, and so let's say we've funded one of these policies, and we are going to be taking out funds, and we'll probably maybe just stick with the syndication example. We're investing it in an apartment syndication, and so obviously there is a preferred return usually on those. There's an expectation of how much that's going to multiply over X number of years. But when you pull the money out of the insurance policy, you're still getting some kind of interest with respect to the money that's in the policy itself, correct? So you're earning that in addition to?
That's correct. So what's actually happening is you are collateralizing your cash value. So you have built cash value policy and you collateralize that, which means you're using other people's money. So you're taking a loan from the insurance company. That allows your capital to earn a rate of return uninterrupted. So it's a compounded rate of return. And so when I go and I make that investment now in the syndication, I have a couple of options. Option number one, let's just say I'm investing in a deal and it's a 3 to 5 year exit, no cash flow at all. In that kind of a deal, when I make my investment, I have no intention whatsoever of paying any loan repayments or interest payments on the loan that I'm taking, because I'm going to wait till the exit and then I'll pay it all back. Now, when I have a deal that has cash flow in it, then I can use the cash flow to either pay down the loan that I took to make the investment, or I can use that cash flow to actually service the debt payment, which is the interest only payment. As an investor, let's just say I'll add one more part to this. Let's say you're just a straight investor and you're going to buy a piece of income property and you're going to take a loan on that. If you were to use bank financing, you lose all control, right? Because they structure the deal and you have structured debt payment. And you know what happens when you miss those payments. Inside a life insurance contract, there is no repayment provision. The reason for that is because when the death payment or the death benefit is paid to the beneficiary, they subtract any outstanding loans or accrued interest owed to the insurance company. So because that is the environment, there's no structured payment. You can choose to pay, to not pay, or partially pay. You can do whatever you want to do with that capital. So that's a level of flexibility that doesn't exist in any other structure that you can work in the financial industry that I'm aware of. One other thing that's very interesting about a life insurance loan is you pay interest on an outstanding daily balance. If you service your debt, let's say that you were going to get a 15-year note from the bank and the debt service on that is $2,500 a month. If you were to borrow that from your life insurance, take a loan, and you funded that, what I would do is I would use that exact bank repayment structure and I would pay my policy back at the same $2,500 a month. With the bank, you're servicing principal and interest. With a life insurance, you are simply paying the principal because you're only billed for the interest at the end of your policy year. So if you have a loan outstanding for the entire year, you're reducing your principal balance on a monthly basis, which means you're paying less interest and you're going to pay off the loan in about 30 to 40% shorter term than if you were paying to a bank. And what I would advise all clients to do is continue making that payment for the full term, because now you're just stacking cash inside of your policy, which you can borrow against to go do another deal.
Okay. And when it comes to that borrowing, you originally we gave an example of like a 300,000 and being able to take out to 250. Is there a percentage that you're looking at when it comes to that? Like as far as whatever the initial investment is, what's the percent that you're able to take back out, and how long will that take? In other words, what if I was? I guess where I'm going with this is, if I was to sell a property and I decided that I wanted to invest in another property, but somewhere in between there, I wanted to, put in place this IBC, how long would I have to wait before I could redeploy part of that capital?
So there's a 30-day hold period from the time that you put the policy in place, and that's actually anti-money laundering. So it's there for reasonable.
A reason.
Yeah, it's there for a reason. Now, let's just say that something really dramatic happened in your world, health related or whatever. Something occurred. We can absolutely go to the insurance company and we can get a loan. We absolutely can do that, but we can't get a loan for you to go invest in something. It has to be a real extenuating circumstance that may need to be backed up, but your capital is available, because at the end of the day, it's your capital that you put in.
Yeah. And from a percentage standpoint, about how much of it would be available?
So what?
And I get that that's going to vary a little bit depending on which product you choose.
Yes, but I think so. Two things here I think that are important. One, the insurance company, whenever you take a loan, they're going to look at where that loan was taken in your policy year. So if you were to take a loan out two months into your policy year, then they are going to hold back 10 months worth of interest on that loan. If you took that on the 11th month of your policy year, they will withhold 1 month of interest. So in the very beginning, if you were to take one right at your policy year, you're only going to be able to borrow out about 95% of your capital, because they're going to hold back 5%, because it's a 5% fixed loan fee. But right at the end, you could probably get, 99% of your capital, because they only need 1 month of interest.
Okay. No, that makes sense. I didn't realize how that affected it. So that's a good explanation. Appreciate that.
Yeah.
And then what are maybe some other advantages, some other things that folks should know about this?
Well, man, there are so many things about using this vehicle that people don't realize. First of all, it's contract law. It's not tax law, which means they can't just go changing the terms whoever gets elected in office. You are grandfathered in because contract law has a lot of, statute in the United States. So we have contract law. Your capital is always growing. You have a guaranteed rate of return. We have a dividend. And while the dividends are not guaranteed, most of the companies that anyone in the IBC world would use have been paying dividends for 150, 160 years consecutively. So we've been through a couple world wars, and we've even been through COVID, and everybody keep paying a dividend, right? So chances are for someone to not pay a dividend, given where we are today, it'd have to be pretty significant reason. It's safe harbor. You have liquidity. I mean, we all need a liquidity plan, right?
For sure.
People will ask me, well, what about your emergency fund? I think your emergency fund should sit inside of a vehicle that's going to earn a rate of return for the rest of your life. So let's say that you have $100,000 of cash value and your emergency fund is $30,000. Then I would just suggest never borrowing below that threshold. Always keep 30,000 of available cash to borrow inside of your policy. You're liquid within about 48 hours. You can go right on your phone and make the request, and it's ACH'd right into your account within about 48 hours. So it's really easy. Think of the protection. I mean, we all need protection, especially if we have families. I know that in all of the investments that I've made, should I expire, my wife is going to have all of the investments completely paid off. Everything I invested in that I still have a loan on, the loan is extinguished. That means it's paid off. She still has the investment and still has a delta because we have leverage on cash flow, on death benefit. So we'll still have death benefit flowing over to her. So you have this legacy component, this protection component, and it's asset protected. Every state's different, but it's asset protected, and that's important.
Yeah, let me go back on to a couple of the things that you said there. One thing I think it's important, you mentioned contract law. And, I think of, some of the talks of taking away capital gains and that being tax law, right? That can change. So you can go in with this strategy that you're going to, keep on, like say, for instance, with a 1031 exchange, you're going to just keep rolling that over, keep selling it into newer properties. And basically just keep rolling it over and defer until you pass away. Yeah. That's one strategy, right? But depending on what happens with the tax code, that may not be a viable strategy in the future if it's changed. So I think what I'm hearing you say with the contract law is that it is you can bank on, no pun intended, you can bank on the on that strategy still working when you plan on utilizing it down the road.
Absolutely. I mean, you are entering into a contract with the insurance company. So you do have those protections. And there is precedence because they did change the tax law back in the 80s. During that time, I think that was savings and loan crisis. And a lot of people were coming out of real estate and they were going into life insurance policies, and they were doing the single premium funding. So you could get a very wealthy person who would move millions of dollars into a single premium with a life insurance product. And at that point, then they knew, now my capital's in there and it's going to be tax free for the rest of my life. So they changed the law, the tax law, but everyone who was already in those products were grandfathered, because you can't change the contract's the contract. So they got it, and then everybody moving forward. So if they're going to make a change in the future that would impact this strategy and, you know, how we're using these products, it's highly likely that the precedent will come into play. The life insurance companies will fight hard, Keith, and then it will change for people getting new policies.
Yeah, that's great. And you also mentioned safe harbor. And, you know, I think of, you know, in Texas, we have your primary residence. And, you know, if somebody gets, say, sued in some type of a lawsuit, they cannot take your, you know, your house from you. They can take all your investment properties. But tell me a little bit about how safe harbor works with respect to this. If something were to happen, is the money protected from lawsuit?
Yeah, so that's going to depend by state and to varying degrees by state.
Okay.
So you'd have to look at whatever state you reside in. But generally speaking, life insurance contracts they replace income. So they're meant for protection. And so because of that, they are given a lot of protection in the law, and they don't allow creditors to come in and take your life insurance away. I mean, think of it as, you know, the little old lady who has her husband's life insurance, and you're going to take this away from her. You know, it's a bad look, right? So it's creditor protected to varying degrees. And as long as you're using the product and it was put in place not for money laundering, and, you know, they figure all that out, I would say you are protected from that. And then part of safe harbor is being non-correlated. So these products are not correlated to the markets unless you're in some of the exotic insurance products, which, again, I don't recommend. I don't use them. Would never do IBC in them. So you're non-correlated in this. So if you have a lot of brokerage assets, you really should look at, you know, at something like this. I really suggest, Keith, that people give it a little bit of a look. So many people are just, you know, walk away from it. It's life insurance. I don't need any life insurance. But there's a lot more to this than just life insurance.
For sure. No, it seems like a great strategy. And one other thing I was going to ask is just with respect to, you mentioned legacy, and with respect to building wealth within this, how does that work when you pass away? You know, are you able to, are your heirs able to receive that, or the beneficiaries that you have listed able to receive that without tax implications, or how does that work?
Yes. Generally speaking, yes, that's going to occur. Now, if you are extremely wealthy and you exceed all of the limits, then, you know, there's different situations going on. But for the average person in the audience, these benefits are passed to the heir tax free. That's the huge advantage of life insurance. Now, what's interesting is we can also use this product as a retirement strategy, because when we get into retirement, and let's say we have a couple $1 million of cash flow or cash value that's been built up over our life, we can then take loans just like we would during our investing years, but now we flip over to a different strategy and we can take loans out and never pay them back. So that gives you tax-free income. And a loan is not a taxable event for any product, for
Right.
anything, right? You go to the bank, it's not taxable.
That's right.
So we can use this as a retirement strategy. And when you think about having brokerage assets or other assets, it allows you to maybe be more aggressive on the front end when you retire, your earlier retirement years. When you're younger, you have more energy, and save the life insurance for the latter part of your retirement. That will allow you
Yeah.
to take a very different look at your whole retirement strategy, and then the legacy component to that your heirs would receive.
Yeah, that's great. That's great. Mark, this has been really good. I like how you've explained it. I think you've explained it very clear, and I think the audience could follow along with how you've kind of laid it out. And there are truly some great advantages. I would encourage everybody to really give this a look and check it out. See how they can implement it within their investments. Mark, how is there anything that we haven't covered that you think is worth mentioning? And then I want to make sure that folks know how to find out more about you. I know you've got something special for our Wealth Flow audience as well.
Yes. So I think we've covered the basics, right? I mean, there's only there's only so much we could really dig into without just overwhelming people. I probably fire hosed them anyway here. So,
Right.
but I have a case study of a client, and I basically a longtime client, and he started slow, built up over a number of years, finally got to the point where he had found an opportunity, takes a $60,000 loan from his policy. And so the special report that I prepared for the Wealth Flow listeners is a case study of that, where you can kind of see what happens. What if he was buying all cash, which is what he used to do? What if he used bank leverage, which most real estate investors do? What does that look like? And then what does it look like in the IBC world? So it's not a long report. It's easy to get through, but people can download that. We'll give the links to that. And then if they want more information, we can dig into it deeper, and then I can illustrate and show them what that looks like if you did that over and over and over and over, the wealth building impact to doing that.
No, that's great. That's great. Fantastic. And how can people find out more about you? And if they'd like to, sit down for a consultation, kind of find out how they can get enrolled in some of this, what does that look like?
Sure. So I have a website. The website address is www.livingbenefits-life.com. So you can go on to there. I have a lot of information there. The goal is to allow people to do a little bit of self-education, have some great FAQs on there where they can learn about some insurance terms. I also have my calendar is on there. So people can click right on the calendar, find a time that works for them. We can do a quick 30-minute call. And I really encourage people to do that because it's only 30 minutes, and maybe it works for you, maybe it doesn't. But I think people should give it a shot and learn more. And then the special report is at the same web address, but at the end of the .com, we /wealth flow. So if it's just livingbenefits-life.com /wealth flow, and that's where they can download that report.
Perfect. No, that's just been great. I appreciate it, Mark. And I got two questions for you that I ask every guest. And one would be just, what advice would you give somebody who's maybe just starting out in their investment journey?
From what I see in my practice and in life as a businessman, I would say take action. Like, it's the number one thing I see out of people. They just get buried in the minutia of things. And I would say gather enough information to make an intelligent decision, trust your gut, take action, and then you can course correct, right? I mean, if you don't take action, you have no shot. There's nothing's going to happen for you. So take action. That would be my advice to anyone starting out.
Yeah, I think that's great advice. And last question I have for you, Mark, and then we'll call it a show, is really, any book recommendation. I ask this for the audience, but I always ask it for myself as well. It doesn't have to be investment related or real estate related or infinite banking related, but it certainly can be just something that's been impactful for you.
Oh, there are so many. I would say probably to do something that maybe a lot of your listeners haven't read, because they probably have hit everyone else's recommendation that you've talked to, would be Becoming Your Own Banker. So for those that are actually on the line and can see this, Becoming Your Own Banker by R. Nelson Nash. I mean, it's what changed my life in doing what I do and being able to work with great people and helping people. I would recommend giving that one a read.
That's a great recommendation. All right. Fantastic, Mark. Well, again, I appreciate having you on the show. And I know it's been a great episode, and I know the audience got a lot out of it. So thank you so much for spending some time with us this afternoon.
Thank you, Keith. It has been really enjoyable.
Great. Thanks.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.